Ever had a year where your income absolutely soared? Only to, look back at past years with much lower earnings and you're just wishing you could somehow balance it all out for tax purposes.
hmm
Today we're diving deep into a fascinating corner of the tax code that allows exactly that for a very specific group of individuals.
That's right. We're talking about IRS Schedule J, Form
Yeah.
1040. And it offers this really powerful tool called income averaging.
Income averaging. Okay.
Yeah, and this isn't just about filling out another form, right? It's about making a strategic election.
hmm
That's the key word. An election that can lead to significant tax savings,
Significant savings.
especially for folks whose income from farming or fishing fluctuates wildly, really unpredictably.
Absolutely. So our mission today is to truly unpack what income averaging is, define precisely who qualifies for this benefit, because I imagine it's quite specific,
Right.
and then meticulously walk you through how Schedule J actually works. We'll focus on the specific lines, the calculations, the stuff that can truly optimize your tax position and, crucially, maybe put more money back in your pocket.
That's the goal.
Okay, so let's unpack this first concept. What exactly is income averaging in the context of Schedule J? And why does it matter so much for these particular taxpayers? What problem is it actually solving?
Right. So income averaging, specifically through Schedule J, it's a method. It's designed to alleviate the tax burden on individuals who see these big swings in their income from farming or fishing.
Okay.
It lets eligible individuals essentially spread out their current year's high income, say, from 2024 over the previous 3 years. The IRS calls these the base years.
So 2021, 22, 23.
Exactly. So instead of having all that high income taxed in one sort of boom year at potentially higher rates.
Right, because of the tax bracket.
Precisely. You
Yeah.
get to, in a sense, reallocate some of it back to those base years.
That sounds almost too good to be true. Like, is there any scenario where doing that isn't helpful? Or maybe some hidden catch?
That's a fair question.
Hmm.
The core benefit, the primary tax saving, it really comes from potentially moving some of that high income out of the higher tax brackets in the current year
Mm-hmm.
and into lower brackets from those prior years. So imagine you had a fantastic harvest or just a, bumper fishing season.
Yeah.
Your income spikes. It pushes you into a higher tax bracket, maybe taking a much bigger percentage of that income in taxes than you'd normally pay.
Right.
With Schedule J, you can effectively use the lower tax rates that might have applied in your, let's say, less prosperous base years.
Ah, okay.
And this nearly always results in a lower tax liability overall because, well, our tax system is progressive. Higher income gets taxed at higher rates.
So the only time it wouldn't help is if those past years were also super high income.
Pretty much. If your past 3 years were also high income years, landing you in the same or even higher tax brackets than your current boom year, then the benefit would be minimal or non-existent. But honestly, that's less common for these industries, given how volatile they tend to be. That's the whole point.
That makes so much sense when you think about the nature of these businesses. I mean, farming and fishing, they aren't like getting a steady paycheck every 2 weeks, right?
Right.
They're incredibly susceptible to things outside your control.
Exactly. The why behind this provision, it's really rooted in that inherent volatility.
Okay.
Farming and fishing income is often highly unpredictable. You've got factors like bad weather, droughts, floods,
Yeah, market prices swinging wildly.
fluctuating market prices for commodities, absolutely. Disease outbreaks in crops or livestock, unexpected changes in fish populations, environmental regulations. The list goes on.
Right.
So a single exceptional year without averaging could lead to this massive concentrated tax bill. Schedule J recognizes that reality.
It smooths it out.
It offers a way to alleviate that concentrated tax burden. It contributes to greater financial stability for these really vital industries. It's truly a mechanism designed for financial stability, preventing a boom year from becoming a bust year just because of a huge tax hit.
So what does this all mean for you, our listener? If you're in farming or fishing and you had a, let's say, significantly better year income-wise in 2024, this means you might not pay as much tax as you initially think. You get to, like you said, borrow those lower tax rates from the past.
That's a good way to put it.
And the form instructions even say it explicitly, right? It says, this election may give you a lower tax if your 2024 income from farming or fishing is high and your taxable income for one or more of the 3 prior years was low.
That's the core language.
That's the primary driver, the real tax-saving opportunity here. But, okay, knowing how specific the IRS always is, who exactly qualifies for this, I'm guessing the definitions are pretty tight.
You are absolutely right. This raises a really important question, and the definitions are very specific. It's crucial to understand this part. Okay. Interestingly, you don't actually have to have been in the farming or fishing business during those base years, 2021, 22, 23.
Really?
Yeah. But your 2024 income, the income you're averaging, must come from a qualifying farming or fishing business. It's about your current year's activity and the source of that income.
Okay, that's a key distinction. So let's break down what the IRS considers a farming business. It sounds like it might cover more than just, planting corn and harvesting it.
It does. It's broader than many people think.
Yeah.
A farming business is defined generally as the trade or business of cultivating land or raising or harvesting any agricultural or horticultural commodity.
Okay, agricultural or horticulture.
Right. And this includes a surprising breadth of activities.
Hmm.
For example, operating a nursery or a sod farm counts.
Ah, interesting.
Raising or harvesting trees that bear fruits, nuts, or other crops, that's farming. Raising ornamental trees is also included, but there's a specific carve-out.
Always a carve-out.
Right. It doesn't cover evergreen trees that are more than 6 years old when they're severed from the roots for sale.
Wow, that's specific. Okay.
And beyond plants, farming also includes raising, shearing, feeding, caring for, training, and managing animals. So ranchers, livestock operations, that's all potentially qualifying farming activity.
Okay. And what about leasing land? That's pretty common in farming. How does that fit in?
Good point. It is common, and there are very specific rules for lease income to qualify for averaging.
I bet.
If you're leasing land to a tenant who's using it for farming, the payments you receive must be based on a share of the tenant's production.
Not a flat rate.
Exactly. Not a fixed cash amount per acre, for example. So if you get, say, a percentage of the soybean crop, that could qualify. But if you just get a set dollar amount, regardless of the yield, that generally won't count as farming income for your Schedule J.
Okay, share of production.
And there's more. This share-based arrangement has to be determined under a written agreement. And that agreement needs to be entered into before the tenant starts any significant farming activities on the land.
So plan ahead, get it in writing.
Precisely. It ensures it's treated as a genuine farming venture, where your income is tied to the output, not just a standard rental situation.
Got it. Are there common things people think are farming, but the IRS says, nope, not for Schedule J?
Yes, definitely some important distinctions. For instance, if you're just providing contract harvesting services, harvesting crops grown or raised by someone else, that's generally not considered your farming business for Schedule J.
Okay, that's a service.
Right. And neither is simply buying and then reselling plants or animals that someone else grew or raised. Those activities are often seen more as service or resale operations, not the direct farming Schedule J aims to support.
Okay, that clarifies farming pretty well. Now let's cast our net over to the fishing side. What exactly is a fishing business for Schedule J?
All right. A fishing business is defined as the trade or business of fishing, where the harvested fish are intended to enter commerce. So selling them, bartering, trading.
Commercial fishing, basically.
Essentially, yes. And the term fish here is actually quite broad in the tax code. It includes finfish, mollusks like clams or oysters, crustaceans like crabs and lobsters. Shrimp, yeah. And basically all other forms of marine animal and plant life. Seaweed, for example.
Oh, really? Okay.
But crucially, it specifically excludes marine mammals like whales or seals and birds.
Got it. So it's not just the actual act of catching the fish, right? Does it cover related activities too?
It does. It explicitly includes the catching, taking, or harvesting of fish, but also the attempted catching, taking, or harvesting.
Even if you come back empty?
Well, the activity itself qualifies. And any other activity that can reasonably be expected to result in catching, taking, or harvesting fish is included too. Plus, any operations performed at sea in support of or in preparation for these fishing activities.
It's like prepping nets or something.
Exactly. And just like farming, there are specific rules for leasing. If you lease a fishing vessel, the payments must be based on a share of the catch or a share of the proceeds from selling the catch.
Same principle. Not a fixed payment.
Correct. Not a fixed charter fee. And again, this has to be determined under a written lease agreement entered into before any significant fishing activities begin.
Okay. What about crew members?
Good question. If you receive compensation as a crew member on a fishing vessel, it only counts as fishing income for Schedule J if that compensation is based on a share of the catch or the proceeds from its sale.
So, if you get paid a daily wage, that doesn't count.
Generally, no. Your income needs to be directly tied to the success of the fishing venture itself, aligning with the whole purpose of Schedule J managing income volatility.
Makes sense. Are there any specific exclusions for fishing, like the evergreen trees in farming?
Yes, there's one main one. Any scientific research activity conducted by a scientific research vessel is specifically excluded. It's about commercial fishing for income, not research activities.
Wow, that is incredibly detailed. It's crystal clear that it's not just about, catching fish or growing crops. The specifics matter immensely for eligibility. Missing one of those details could mean you miss out on potentially big tax savings.
Absolutely. Precision is key here.
Okay, so with these definitions firmly in mind, before we get into the actual line-by-line calculations on the form, what do people need to gather? What documents do you need to get started with Schedule J?
Right. Preparation. What's interesting here is how Schedule J forces you to look both backward and forward.
How so?
Well, you absolutely need your past records, obviously. But you also need to think strategically about how using Schedule J this year might impact your taxes in future years. It's not always just a one-and-done calculation.
Okay, so we're building like a financial bridge between our current year and past tax years. What are the essential documents, the foundation for that bridge?
You'll definitely need copies of your original or amended income tax returns for the previous 3 base years. So for filing in 2025 for the 2024 tax year, you need your 2021, 2022, and 2023 returns.
Okay.
And you need the actual numbers from the taxable income, maybe details from Schedule D if you had capital gains, things like that. You'll be referring back to specific figures.
What if someone, can't find those old returns? Things get lost. Is there a way to get them from the IRS?
Yes, absolutely. The IRS has procedures for this. You can use Form 4506, request for copy of tax return. There's usually a fee per return for this service.
A fee? Okay.
Yeah, but there's an exception. If your main home, principal place of business, or your tax records are located in a federally declared disaster area, the IRS will typically waive that fee.
Good to know. Is there another option? Maybe cheaper?
Yes, there is.
Yeah.
If you don't need the full exact copy of the return, but just the key information, you can request a free transcript using Form 4506T, Request for Transcript of Tax Return. Transcripts provide most of the line items from your return and are often sufficient for things like Schedule J calculations.
Or transcripts. Okay. Probably faster, too.
Often, yes. But either way, it's wise to request these well in advance, especially if you're filing near the deadline. It can take time for the IRS to process the request.
Good advice. Now, you mentioned future planning, too. Why does that matter for something we're doing for the 2024 tax year?
It's crucial because income averaging isn't necessarily a one-off election. If you use Schedule J for your 2024 return, the specific calculations and the resulting tax figures from this year's Schedule J will directly impact how you compute your tax if you choose to use income averaging again in 2025, 2026, or even 2027.
Ah, so the base year calculations get carried forward somehow.
Exactly. The starting point for a base year's income might be adjusted based on a prior Schedule J calculation. So you absolutely need to keep a complete copy of your 2024 tax return, including the filled-out Schedule J, for potential future filings.
Right.
It really highlights the long-term benefit and the absolute necessity of meticulous record-keeping if you're in these industries and thinking about averaging as a regular strategy. It becomes an ongoing process.
Okay. I also saw a note, something about filing status. A name change. Does that affect anything when looking at old returns?
Yes. It's a minor point, mostly terminology, but good to be aware of to avoid confusion. For tax years, starting in 2022, the filing status that used to be called qualifying widow is now officially called qualifying surviving spouse.
Okay.
The actual rules for qualifying for the status haven't changed at all. It's purely a name change. The IRS instructions for Schedule J usually adapt the term to match the specific year you're looking at. So if you're working on your 2021 base year, it might still say qualifying widower in the 2021 context, but for 2022 onwards, it's qualifying surviving spouse. Just something to be aware of.
Good clarification. Now, are there specific situations where this income averaging election just doesn't apply? Or maybe complex interactions with other tax forms, like, say, loss limitations?
Good question. There are a few important limitations and interactions to keep in mind. First, this Schedule J election does not apply when you're figuring your alternative minimum tax, or AMT. That's calculated separately on Form 6251.
Okay, so AMT is separate.
Completely separate calculation. Also, you don't have to go back and refigure the tax liability of any minor child who might have been required to use your tax rates in prior years, the so-called kiddie tax, just because you're using Schedule J now.
All right.
Now, regarding losses, This is important for some filers. The old excess farm loss limitation rules were temporarily suspended some years back, through 2028 actually. They were replaced by the excess business loss limitation rules currently in effect through 2028 as well.
Okay.
The key thing is, other limitations like the at-risk rules and the passive activity loss rules are applied before you figure out if you have an excess business loss. And here's a crucial detail for Schedule J and maximizing your tax savings. The amount of any excess business loss that's allocable to your farming or fishing business is not used in calculating your elected farm income on Schedule J, line 2A.
Why is that?
It basically prevents getting a double benefit. You can't use the same loss to both reduce your current income and reduce the income you're electing to average. It ensures your elected farm income is calculated correctly before applying that averaging strategy.
Got it. That makes sense. So, okay, you've got your past returns, maybe requested transcripts. You know for sure you qualify under those specific definitions, and you're ready to make the selection. Let's get into the heart of the form itself, starting with that really crucial number, the elected farm income. This sounds like where the real strategy comes in for tax savings. Okay, this is it, the nitty-gritty. This is where the magic of income averaging, actually happens on paper. And you mentioned this is where you can make some strategic choices that directly affect your tax bill.
Exactly. The form itself guides you through the process, but understanding why you're putting certain numbers where and the choices you have, that's key. It walks you through calculating your tax in a way that incorporates your past income, effectively smoothing things out. Let's go section by section. So Section A starts with your current year's picture. Line 1 is the baseline.
Okay, line 1, 2024 taxable income. Seems straightforward.
It is. You just enter your total taxable income for 2024 right here. You'll pull this number from your main tax form, Form 1040 or 1040 SR for seniors, or 1040 NR for non-residents, specifically line 15. This is your starting point, your total taxable income before we do any averaging. Think of it as the whole pie.
Right. And then comes line 2A, which you called the strategic heart. Why is this one so important?
It truly is the core decision point. Line 2A asks for your elected farm income. This is where that significant tax-saving opportunity lies. You enter your income, gains, losses, deductions, everything directly attributable to your farming or fishing business.
Directly attributable. Okay.
Yes. And if you happen to operate both a farm and a fishing business, you just combine all the relevant amounts from both activities here. One key constraint. The total elected farm income you enter on line 2A cannot be more than your total 2024 taxable income on line 1. You can't average more income than you actually have.
Makes sense. So what's the tax-saving nugget here, the big strategic element?
This is absolutely critical, and it's stated right in the IRS instructions. It says, and I'm paraphrasing slightly, you don't have to include all of your taxable income from farming or fishing on line 2A.
You don't have to.
No. It goes on to say, it may be to your advantage to include less than the entire amount, depending on how the amount you include, affect your tax bracket for the current and prior 3 tax years.
Wow. So it's a choice.
It's a choice, a proactive strategic decision. You're not forced to average all your qualifying income. You can choose an amount up to the total that works best for you. By carefully selecting how much income to put on line 2A, you can effectively, well, manipulate isn't quite the right word, but optimize your taxable income for both the current year and those 3 base years.
To hit the sweet spot in the tax brackets.
Exactly. You might push just enough income back to fill up lower brackets in the past without pushing yourself into a higher bracket this year, or vice versa. It's about finding the balance that results in the lowest overall tax across the 4 years involved. This isn't just data entry, it's a powerful lever for tax optimization. It requires some calculation, maybe running the numbers a few ways.
That's a huge insight. It's not just plugging numbers in, it's being smart about which numbers and how much. So, okay, where would people typically find these bits and pieces of elected farm income on their tax forms? It sounds like it could come from several places. It absolutely can. It's often spread across different parts of your return. For instance, it could be wages you received as a shareholder in an S corporation that's engaged in farming or fishing.
Okay.
Or compensation you got as a crew member on a fishing vessel, provided it was based on a share of the catch. It also includes the deductible part of your self-employment tax, which shows up on Schedule 1, but only the portion directly related to your farming or fishing SE income.
Right. You have to allocate it.
You do. If you're involved in Capital Construction Fund, or CCF, there are specific adjustments. Then you have the usual suspects. Income or loss from Schedule C, if you're a sole proprietor in farming fishing. Schedule D for capital gains and losses from assets used in the business. Schedule E, Part 2, for income flowing through from partnerships or S corporations involved in farming fishing. Schedule F, of course, the main profit or loss from farming form. Form 4C797 for sales of business property used in farming or fishing. Form 4835 for farm rental income based on crop shares. Potentially Form 8903 for the domestic production activities deduction if it relates to farming fishing, though that's less common now. And Form 8949, which details the sales of capital assets reported on Schedule D. And importantly, elected farm income also includes gain or loss from selling property that was regularly used in your farming or fishing business for a substantial period.
Even if you've stopped the business.
Yes, even if you've ceased operations, if you sell that property within a reasonable time, the IRS generally presumes 1 year is reasonable that gain or loss can still be considered attributable to the business for Schedule J.
Okay. But not land itself.
Correct. It specifically excludes income gain or loss from the sale of land, and also development rights, grazing rights, and other similar rights. It's focused more on the operational assets.
Got it. Now, what about lines 2B and 2C, capital gain details? Why do we need to break that out separately?
Right, lines 2B and 2C handle capital gains. If part of the income you elected on line 2A includes net capital gain, you need to specify that here. Line 2B is for the portion of your elected farm income from 2A that's treated as net capital gain. That's generally your net long-term capital gain minus your net short-term capital loss.
Okay.
The amount you put on 2B can't be more than either your total net capital gain for the year or the net capital gain specifically from your farming fishing business, whichever is smaller. You isolate the farming fishing capital gain within your elected income.
And 2C.
Line 2C is for a specific type of capital gain, unrecaptured Section 1250 gain. This usually relates to selling depreciated real property used in the business. You enter the smaller of the amount on line 2B or the amount of unrecaptured Section 1250 gain that's attributable to your farming or fishing business.
Why break these out?
Because capital gains, especially long-term ones in this Section 1250 gain, are often taxed at different, usually lower rates than ordinary income. By identifying these amounts here, you ensure they get the correct preferential tax treatment when you later calculate the tax for the base years using specific capital gain worksheets. It preserves those lower rates during the averaging calculation.
Ah, okay. Precision again. So after we've strategically chosen our elected farm income on 2A and broken out any capital gains on 2B and 2C, what's next?
Next is line 3. Taxable income minus elected farm income. This is simple math. You just subtract line 2A, your chosen elected farm income, from line 1, your total 2024 taxable income.
Okay.
The result is basically your 2024 taxable income without the portion you've decided to average out. It's the part of your income that will be taxed normally in the current year.
And then we figure the tax just on that remaining amount.
Exactly. That's line 4, tax on remaining 2024 income. You calculate the tax liability solely on the amount from line 3. And you use the standard 2024 tax calculation methods, the 2024 tax table, or the appropriate 2024 tax computation worksheet, the qualified dividends and capital gain tax worksheet, the Schedule D tax worksheet, or maybe the foreign earned income tax worksheet, depending on your situation.
So this is the first piece of your final tax bill under averaging.
Correct. It's the tax on the part of your 2024 income that isn't being averaged. We set this amount aside for now. It's the first component of the overall tax calculation we're building. Okay, that's Section B. This is where we start looking back in time, leveraging those potentially lower tax brackets from the past. We take 1/3 of the income you elected to average and conceptually add it to your 2021 taxable income to see how it impacts the tax for that year.
So we're basically doing a mini rerun of our 2021 tax return, but with this extra slice of income added in. Line 5 seems to be the starting point for 2021.
It is. Line 5 asks for your 2021 taxable income. Now, the instructions here get a little conditional depending on your history.
How so?
If you use Schedule J to figure your tax for 2023 or 2022, or even 2021 itself may be amending, you'll need to refer back to specific lines from those prior Schedule J forms, because those calculations would have already refigured your 2021 base year income.
Ah, okay. Carry forward effect.
Exactly. But if you didn't use Schedule J in those recent years, you generally just enter the taxable income from your original or amended 2021 Form 1040, line 15.
Okay, but what if that 2021 income was 0? Or negative, like a loss?
Great question. That's a crucial point for maximizing tax savings. If your 2021 taxable income was 0 or less, you must complete a special worksheet called the 2021 Taxable Income Worksheet found in the Schedule J instructions.
Another worksheet.
Yep. This worksheet is vital. It's common for farms or fishing operations to have loss years or years where net operating losses, NOLs, wiped out income. This worksheet helps you correctly refigure the 2021 taxable income specifically for averaging purposes. It ensures you get the full benefit by allowing those past losses to effectively absorb some of the income you're averaging in from 2024, keeping it in the lowest possible brackets for 2021.
Okay, let's not read out the whole worksheet, but can you give us the gist? What's the purpose of that 2021 taxable income worksheet? What's it fundamentally doing?
Absolutely. Its core purpose is to recalibrate your 2021 taxable income so it serves as an accurate and frankly optimized base for averaging, especially when you have complexities like NOLs or net capital loss deductions from that year.
Recalibrate.
Well, it starts with your 2021 income before certain deductions like NOL carryovers. Then it carefully adds back or adjusts for things like capital loss deductions and NOLs in a way that prevents getting a double tax benefit. For example, if you had an NOL in 2021 that you carried forward, the worksheet adjusts for that. If you had capital losses, it adjusts how those interact with the averaging calculation.
So it finds the true starting point for 2021 before the averaged income gets added.
Essentially, yes. It determines the most accurate starting point for 2021, maximizing the space available in that potentially low-income year to absorb the incoming averaged income from 2024 without pushing you unnecessarily into higher 2021 tax brackets. The IRS provides detailed examples showing how complex situations, like having NOL carrybacks and refigured capital losses, feed into this worksheet to get the right number for line 5. It ensures the prior year starting line is set correctly for maximum averaging benefit.
Wow. Okay, that precision really underscores why you need those accurate prior year returns and good records. So once we have that carefully calculated 2021 base income on line 5, what's line 6?
Line 6 is 1/3 of elected farm income. This is nice and straightforward. You simply take the amount you entered way back on line 2A, your total elected farm income for 2024, and divide it by 3.0.
Okay.
This is the core averaging mechanism in action, spreading that current year income slice equally across the 3 base years. So 1/3 goes to 2021.
And line 7 then just adds the 2021 base to that 1/3 slice.
Yes. Line 7 is the combined 2021 income. You simply combine the amount from line 5, your adjusted 2021 base, and the amount from line 6, 1/3 of your 2024 elected income. If the result happens to be 0 or less, you just enter Dando 0. This line represents your new hypothetical adjusted taxable income for 2021, incorporating the average income.
Okay, now we have this new income figure for 2021. How do we figure the tax on it for line 8? Do we use current 2024 tax rates or the rates from back in 2021?
That's the key distinction and crucial for the tax savings. Line 8 is the tax on combined 2021 income. You figure the tax on the amount from line 7 using the 2021 tax rates and rules.
The historical rates. Got it.
Yes. This means you'll need to dig out the official 2021 tax rate schedule X for single filers back then, Y1 for married filing jointly, Y2 for married filing separately, Z for head of household, and you must use the appropriate 2021 tax worksheets.
Like the capital gains worksheets.
Exactly. For example, if the elective farm income you put on line 2A didn't include any net capital gain, but you did have qualified dividends or other capital gains back in 2021, you might need to use the 2021 version of the qualified dividends and capital gain tax worksheet. This ensures that portion of your income still gets taxed at the preferential 2021 capital gains rates.
And if the elected income did include capital gains, that amount from line 2B.
Right. If your elected farm income does include net capital gain, from line 2B and maybe 2C for unrecaptured 1250 gain, then you must use the 2021 Schedule D tax worksheet to figure the tax for line 8.
Okay.
And when you fill out that 2021 Schedule D tax worksheet, you specifically allocate 1/3 of the amount from your current Schedule J, line 2B and 2C, if any, to that 2021 calculation.
So you carry that third of the capital gain back.
Precisely. And here's a critical instruction. You do not reduce this allocated capital gain income by any 2021 capital loss carryover to 2022 that might have existed on your original 2021 return. That prevents a potential miscalculation. Also, if you happen to file Form 2555 for foreign earned income back in 2021, you'd need to use the 2021 foreign earned income tax worksheet, potentially in conjunction with the other worksheet.
Oh, okay.
The key takeaway is you're applying the specific tax rules and, crucially, the tax rates from that base year, 2021, to this newly calculated income figure on line 7. That's how you lock in the potential benefit of lower historical rates. All right, moving on to Section C. Now, we essentially repeat that exact same process, but for the next base year, which is 2022, it's all about consistency, applying the same logic to a different historical period to capture the tax benefits using that year's specific rates and rules.
Okay, makes sense. So line 9 will be similar to line 5, but pulling in our 2022 taxable income as the starting point for that year's piece of the averaging.
Exactly. Line 9 asks for your 2022 taxable income. And just like for 2021, the entry here is conditional. If you use Schedule J for your 2023 tax return, or maybe amended your 2022 return using Schedule J, you'd refer back to that prior calculation.
Right, the carry forward effect again.
Correct. Otherwise, if you didn't use Schedule J recently, you enter the taxable income directly from your 2022 Form 1040, or 1040 SR&R, line 15. And crucially, again, for maximizing savings, if that 2022 amount was 0 or less, you must complete the 2022 taxable income worksheet.
Another worksheet. Okay. Can we briefly touch on the 2022 taxable income worksheet? Same core purpose as the 2021 version, adjusting for losses and things.
Yes, the structure and purpose are fundamentally the same. It's all about recalibrating your 2022 taxable income to serve as the most accurate and optimized base for absorbing that one-third slice of 2024 income. It ensures that things like 2022 net capital loss deductions, any 2022 NOLs or NOLs carried to 2022 are precisely accounted for.
So even if your 2022 return showed a loss, this worksheet helps figure out the right starting point for averaging.
Exactly. It might result in a negative number on line 9 or 0 or a small positive number, but it's calculated meticulously to ensure that when you add the averaged income, it lands in the appropriate 2022 tax brackets, maximizing the potential savings from using those historical rates. It makes sure every bit of potential benefit from that lower income year is available.
Fascinating. Okay, so after that careful refiguring for 2022, line 10 should be easy, right? Just bringing over that same one-third amount.
Correct. Line 10 is one-third of elected farm income. You simply enter the exact same amount you calculated back on line 6. It's that consistent one-third share of your 2024 elected farm income being applied now to the 2022 base year.
And line 11 combines them for 2022.
That's right. Line 11 is the combined 2022 income. You just combine line 9, your adjusted 2022 base, and line 10, the one-third slice. If the result happens to be less than 0, you entered it as a negative amount here. This gives you the new hypothetical adjusted taxable income for 2022.
And then line 12, we calculate the tax on that amount using the 2022 rates.
Precisely. Line 12 is the tax on combined 2022 income. First, if line 11 is 0 or less, the tax is 0, so you enter next 0 on line 12. Otherwise, you figured the tax on the positive amount from line 11 using the 2022 tax rates and the relevant 2022 worksheets.
So, got to pull out the 2022 tax data.
Yep, the 2022 tax rate schedules for your filing status, and potentially the 2022 qualified dividends and capital gain tax worksheet, or the 2022 Schedule D tax worksheet. Remember, if you use the Schedule D worksheet, you allocate one-third of the capital gains from your 2024 elected income, lines 2B and 2C, to 2022, and again, you do not reduce that allocated gain by any 2022 capital loss carryover to 2023.
Same rule as for 2021.
Same rule. And if Form 2555 was involved in 2022, you'd use the 2022 Foreign Earned Income Tax Worksheet. The goal remains the same. Accurately recalculate the tax for that specific base year, 2022, as if this extra slice of income had been earned then, locking in those 2022 historical rates.
Okay, Section D. And finally, the last base year, 2023. This brings our historical look back right up to the year before the current one we're filing.
Exactly. This final base year calculation completes the averaging part of the process itself. It calculates the tax impact for the most recent prior year, setting us up for the final comparison in Section E to see the actual tax savings, the last piece of the averaging puzzle.
Makes sense. So line 13, this will be for our 2023 taxable income.
Yes. Line 13 asks for your 2023 taxable income, entered conditionally, just like the previous two base years. If you happen to use Schedule J when you filed your 2023 return, maybe you amended it later, you'd reference that specific prior Schedule J calculation.
Otherwise, just use the 2023 Form 1040.
Correct. Otherwise, you enter the taxable income from your 2023 Form 1040, or 1040 SR&R, line 15, and you guessed it. If that amount is 0 or less,
Use the worksheet.
you got it. You must use the 2023 taxable income worksheet to figure the correct amount to enter on line 13. Again, this is to properly account for any losses, NOLs, or specific adjustments from 2023 that might affect the ideal base income for averaging.
All right, let's quickly cover the 2023 taxable income worksheet. Same strategic purpose, right? Optimizing that base.
Exactly the same pattern and purpose. It ensures your 2023 taxable income serves as the most effective base for absorbing that final one-third slice of your 2024 elected farm income. It meticulously adjusts for elements like 2023 net capital loss deductions, any 2023 NOLs, or NOLs carried to 2023.
Ensuring maximum benefit from that year's rates or lower income level.
Precisely. This level of detail across all three base year worksheets ensures you're maximizing your ability to benefit from those prior years' potentially lower tax rates or available income space, even if your actual reported income was low or negative. It's about optimizing the past to reduce your current tax burden.
Okay, we've run the gauntlet of base year worksheets now. Line 14 should be familiar territory.
Indeed, line 14 is 1/3 of elected farm income. Just like lines 6 and 10, you simply enter the same amount again, that consistent 1/3 distribution of your 2024 elected income.
And line 15 combines the 2023 base with that final third.
Correct. Line 15 is a combined 2023 income. You combine line 13, your adjusted 2023 base, and line 14. Again, if the result is less than 0, you enter it as a negative amount. This gives you the final adjusted taxable income figure for the 2023 base year for averaging purposes.
And then one last time, we figure the tax for that amount using the 2023 rates on line 16.
Yes. Line 16 is the tax on combined 2023 income. If line 15 is 0 or less, the tax is 0, enter NYSE 0. Otherwise, you figure the tax on the amount from line 15 using the 2023 tax rates and relevant 2023 worksheets.
So the 2023 tax tables, 2023 capital gains worksheets.
That's it. The 2023 tax rate schedules, potentially the 2023 qualified dividends and capital gain tax worksheet, or the 2023 Schedule D tax worksheet. And remember the rule. If using the Schedule D worksheet, allocate 1/3 of the capital gains from your 2024 lines 2B and 2C to 2023, and do not reduce that allocated gain by any 2023 capital loss carryover to 2024. And the 2023 Foreign Earned Income Tax worksheet if needed. This calculation completes the recalculated tax for each of the three base years, all specifically designed to capture the maximum tax savings possible from the income averaging election.
Okay, section E. We've done all the heavy lifting, right?
Yeah.
Figuring out the tax for each piece. The current year's non-averaged part on line 4, and then the average portions taxed in 2021, 2022, and 2023 on lines 8, 12, and 16. Now it's time to bring it all together to see that final average tax liability. This is the big reveal.
This is indeed the culminating step. All those careful calculations come together right here. This section is where you ultimately compare the total tax calculated using income averaging to the sum of what your tax actually was in the prior years, revealing the real benefit, the actual tax saving you've achieved by making this election.
Okay, so line 17 looks like it just adds up all those calculated tax pieces.
Precisely. Line 17 is the sum of average taxes. You add together 4 numbers. Line 4, tax on 2024 non-averaged income. Line 8, recalculated 2021 tax. Line 12, recalculated 2022 tax, and line 16, recalculated 2023 tax. This sum represents your total tax liability for 2024 under the income averaging method.
Okay, that's the total tax based on spreading the income out. And line 18 just repeats that number.
Correct. Line 18 simply has you re-enter the amount from line 17. It's just a layout thing, a confirmation step before the final subtraction.
Then we get to lines 19, 20, and 21. These seem different. They ask for prior year actual taxes, what you paid before this averaging calculation.
Exactly. These lines are absolutely crucial for the comparison that determines your actual tax savings.
Yeah.
Lines 19, 20, and 21 ask for your prior year actual taxes for 2023, 2022, and 2023, respectively.
Where do you get these numbers?
Again, it's conditional. If you used Schedule J in any of those prior years, say for 2023, 2022, or 2021, you need to enter the tax amount from the relevant line on that prior Schedule J because that form would have already refigured your final tax for that year. But if you didn't use Schedule J in those years, you enter the tax directly from line 16 of your original or amended Form 1040 for that specific year. 2021 for line 19, 2022 for line 20, 2023 for line 21.
And just the regular income tax, right? Not other taxes.
Very important point. You only include the tax imposed by Section 1 of the Internal Revenue Code, your regular income tax. You specifically exclude other taxes, like the AMT, tax from Form 8814, kitty tax on lump sum distributions from Form 4972, amounts from recapture of education credits, or any repayment of the Health Coverage Tax Credit, HCTC, just the plain income tax for that year. And make sure to use the corrected final tax amount if your return was amended or changed by the IRS.
Okay, so we're taking the total tax calculated under averaging, line 18, and we're about to compare it to what we actually paid or would have paid without averaging in those specific past years. This is where the savings number comes from.
Exactly. First, line 22 is the sum of prior year actual taxes. You simply add up the amounts from lines 19, 20, and 21. This total represents your combined actual tax liability from the past 3 years, or the refigured amounts if prior Schedule Js were filed.
Got it. And finally, the moment of truth. Line 23 gives us the final tax due for 2024.
Indeed. Line 23 is your final tax, the ultimate tax saving result. You subtract the sum of your prior year actual taxes, from line 22, from the sum of your calculated average taxes, from line 18. This difference is your final income tax liability for 2024 after applying the income averaging election.
And that number should be lower than what it would have been without Schedule J if the averaging worked out.
That's the hope, and often the case. The difference between what your 2024 tax would have been without Schedule J and this new figure on line 23 represents your tangible dollar amount tax saving from using this strategy. You then take this final tax amount from line 23 and include it on your main form 1040, 1040SR, or 1040NR on line 16, which is your total tax line. It directly reduces your overall tax bill for the year.
Fantastic. But there's a catch. Or rather, a final check, right?
Yes, an important caution stated right on the form itself, which really underscores the strategic choice involved here. It says something like, your tax may be less if you figure it using the standard 2024 methods. Attach Schedule J only if you're using it to figure your tax. Meaning Schedule J is an election. It's optional. You should always compare the final tax result you get on Schedule J line 23 to what your tax liability would be if you just calculated it the normal way for 2024 without averaging.
Do both calculations.
Absolutely, do both calculations. Whichever method results in a lower tax liability is the one you should use. You only file Schedule J if it actually saves you money compared to the regular calculation. It's a powerful tool for optimization, not just a mandatory form. It's all about finding the best possible tax position for your specific financial situation in that particular year. Hashtag outro wrap.
Well, that was a truly deep dive into IRS Schedule J. It's incredible how these, really specific tax provisions can offer such significant financial advantages for particular industries, especially when their income isn't steady year after year. It's a prime example of how really understanding the tax code, getting into the weeds, can directly put money back in your pocket.
It really highlights how understanding these nuances, these details, and honestly, just being meticulous with your records, past and present, can translate directly into tangible savings. For farmers and fishers, Schedule J isn't just another form to fill out. It's a genuine strategic tool for managing that income volatility and intelligently reducing their overall tax burden over time.
Absolutely. And that ability to smooth out the peaks and valleys, and especially that strategic choice you emphasized on line 2A about deciding how much income to actually elect for averaging, that's a really powerful example of proactive tax planning in action. It's not just about compliance, right? It's about optimization. It's about being a smart taxpayer.
Indeed. And remembering to keep those prior year returns handy, and even thinking about future income averaging by keeping a copy of this year's completed Schedule J. It really shows this isn't just an annual task. It becomes an ongoing part of a robust financial strategy for people in these fields. It's a continuous process, really, looking backward to help your finances move forward.
So what does this all mean for you, our listener? I mean, even if you're not personally in farming or fishing, this deep dive really shows the importance of exploring every potential corner of the tax code that might be specific to your profession or your business. You never know, right? There might be a tailored, significant tax-saving opportunity just waiting there if you know where to look and how to use it.
That's a great point. And this deep dive specifically into Schedule J, it reveals just how deeply interconnected past and present tax years can be for certain taxpayers. Which kind of raises a fascinating final thought, doesn't it? How many other niche tax forms or specific elections exist out there buried in the code that could similarly reshape your tax liability if only you knew about them? And thinking about that, how might that encourage all of us to take a more proactive, maybe even a year-round approach for our finances instead of just that mad scramble come tax time?